welcome back to the Compass. Recording this episode on Wednesday, May 14th. So kind of the end of Q1 reporting for many of the many mining companies here. With me, as always, we have Sam Pelaez, President, CEO, CIO of Olive Resource Capital. And my name is Derek Macpherson. I'm the Executive Chair of Olive. A couple things news-wise to talk about. We'll talk a little bit about Q1 reporting, what we look for in a couple different companies and how it compares to sort of other stuff out there. And then also, there was some more M&A out there in the market, and finally one of our names got taken out. So on Monday this week, PanAmerican Silver announced the acquisition of MAG, a position that we hold. Sam, you want to run us through the metrics on that transaction?
Well, before we get into the metrics, I think it's sign of relief because this is the space we've been on. We've been banking on takeovers. This is the first one in our portfolio for some time. Before I get into the metrics, I just want to say it looks good. It looks good for PanAmerican. They are buying above their current multiple, but I think you would argue, or you could argue, that this is the type of asset that deserves a premium multiple. It's as tier one as it gets in the world of silver. Hence the reason why we own MAG. From my perspective, I wish this company had been allowed to run further after 15 years of being in the market. And now finally starting to outperform when the cash flows start coming in. My personal view is it was inevitable that it was going to be subject to a takeover, but I wish it had lasted a little bit longer to perform on this cycle. Having said that, there is always a chance that you may get an interloper or another company coming in with a superior bid. I don't think you can discount that, and we'll get into that in a second, particularly because they have a partnership on the asset. But the metrics are, give or take, $2 billion US takeover, combination of shares and cash. Stock is trading about 1.8 billion because of the PanAmerican shares having come off, partly on the announcement, partly on what's happened on the market over the last few days with precious metals and some of the performance of the complex. But roughly, MAG makes about $30 million currently in profit a quarter. So give or take, that's about a 16 to 17 times earnings multiple, or about a 6% yield. PanAmerican trades at about 12 times on that same multiple. So they're paying about 50% more than what they're currently valued for this asset. So I guess that's probably as much or as far as the board allowed them to go. But I think pretty good multiple, just thinking about it.
It is a good multiple, but the reality is it's a skinny premium though too, right? It's only 20, I think it's 27% at the day of the moment of announcement. It's probably a little bit lower now, given PanAmerican's pullback. That's probably at the bottom end of typical premium ranges that you would see, especially for a tier one asset. So while the multiple's high, the premium, which a lot of people look at, is kind of a little bit skinny on the skinnier side. And that kind of leads into the, hey, is there another buyer out there? And I think the obvious, is there, and that's always the first thing you look at when you take a look at these takeout situations, right? If there is another potential buyer, then do you hang around to the end of the deal, or do you blow your paper out into the liquidity that's created by the initial transaction, kind of where we are now? Any kind of, you throw a dart at the wall and say the odds are X.
Sure. But there's two things here, and we haven't sold our position. Actually, we increased our position after the announcement, after it traded down based on the PanAmerican implied value when the PanAmerican shares came off. And I think there's two reasons for that. One, to your point about the skinny premium, we're just coming off the Caliber Equinox failed not failed, on its way to failure, uh, Equinox made a superior bid, effectively outbidding itself, just to get the shareholders on board. There's no reason why we can't get something of the likes here. MAG is a pretty well, institutionally owned company. Now, the multiple is good. As I said, is above what PanAmerican trades at, but the Juanicipio asset is a tier one asset for a start. Number two, the setup that MAG has, and I guess this is where we bring in Fresnillo, is atypical, right? It's got effectively a carried interest, a passive interest in a Fresnillo mine, in the Juanicipio mine. And you could argue that Fresnillo is one of the best silver operators out there. Pretty well established company out of a conglomerate out of Mexico. And maybe they're the ones that should be looking at consolidating the asset under their ownership. Now, there's a problem with that. I told you that PanAmerican trades at 12 times, sort of like their cash from operations multiple. I didn't really look at the pure net income. But Fresnillo trades at half that. So for Fresnillo to do this deal with paper would make no sense. It would be too dilutive. Fortunately, they're sitting on about $1.3 billion of cash, which at the $2 billion price, that 2.1 billion price that PanAmerican set, it's about 2/3 of the way there. So, maybe some access to debt or a combination of cash and shares that, has a much larger component of cash rather than shares could be an option.
Yeah, it's interesting when you're figuring out what to pay and what makes sense. If you're the acquirer, one of the things that you actually think about and that your bankers think about is what can the obvious buyers pay, right? And what are your risks? So I think, all that math that you just did out loud that we did post the deal, there was, 2 or 3 banking associates and a senior investment banker and a vice president all sitting in a room kind of coming up with a number that said, okay, yeah, this is what Fresnillo can't pay this, or will struggle to pay up at this level. So let's do it. And you see that all the time, right? And it seems odd, and maybe that's why they went with such a premium multiple on the transaction. Also, most boards won't accept merger of equals. Does not usually very difficult to sell to a board. And certainly in this case would have been where it is where it's a clear takeover. So I think this probably makes PanAmerican a better company. It would be, even though they only own 44% of it, probably the best asset in PanAmerican, based on what I know about their portfolio. Maybe they've got a couple other good ones similar to this, but probably the best asset in their portfolio. We made the argument that Juanicipio is the best silver mine in the world, or one of the best silver mines in the world. It actually leverages them back to silver more, which I think is something that, the Yamana transaction pushed them more towards gold. So I think all those things kind of help out PanAmerican Silver in this case. So we like the transaction from that perspective, but I think there is still a possibility. Fresnillo's a big company, so they might move slow, but they might take a run at it. And keep in mind, they 100% have better information than PanAmerican. So they know if there's a big leg of growth in this asset that they can fund themselves, or that they can fund out of cash flows. They've got all the information. And there's a likely scenario here, and this is the interesting part, where Fresnillo, there's a possibility, and I don't know what the rules are within the joint venture that MAG and Fresnillo have, but typically you require the other party's permission to disclose information on the asset. So either Fresnillo knew about this potential bid, and because MAG asked permission to share material non-public information about the asset with PanAmerican, or the flip side of that is I guess the other side of that is that PanAmerican is buying it based on public disclosure, which is also a possibility. With large companies, that's not completely uncommon. So it'll be interesting to see how it plays out. I think we're going to hold our MAG, maybe not till the end, but till the outcome is a little more certain.
PanAmerican is as well established as a silver gold company goes. Um, so I don't think you're assuming a lot of risk at this point, other than market risk, by staying invested here. But you do get the opportunity and the free option on that potential superior bid coming out of nowhere. Obviously, the logical one would be Fresnillo, but you can never discount. It's a tier one asset, right? It may attract groups that are completely unexpected, right? Who may have a good multiple paper right now.
It's interesting. An asset like this, could you attract a royalty company? You have a tier one operator in Fresnillo. You have an asset where you've got a carried interest. Does a Silver Wheat and look at it and go, yeah, we could do that deal, and we got better paper than that. Or sorry, wheat, precious metals, not Silver Wheat. Sorry, Randy.
It's been like 10 years, but we still refer to it as Silver Wheat.
Silver Wheat as long as I can remember. But wheat and precious metals. Do they look at it and go, yeah, this is a great silver exposure for us? And maybe they do it. They structure a deal. I liken it to. Do you remember when I liken it back to when a Cisco was getting taken out, the original Cisco. If you remember, there was a hostile bid from Gold Corp for a Cisco mining when it says they had Canadian Malarctic, and that hostile bid turned into, that was option one, and then there was an option where Agnico would buy 50%, and there was a royalty, and and then it turned into, Yamana would buy 50%, and then it turned into Agnico and Yamana splitting it down the middle. So maybe there's that kind of transaction out there as well. I mean, that's the kind of thing that happens when you have these really high quality assets, though, right? Because there's lots of people who want a tier one silver asset in their portfolio.
Yeah, and I like that you brought on the point of the royalty companies, because obviously this is a hybrid. It's a passive interest. Fresnillo is the operator and the majority owner. I believe the ratio is 44% attributable to MAG. But you could construct this as a royalty of some sort, and potentially, if someone like Wheaton Precious comes in over the top, they could then sit down with Fresnillo and say, is there a logical way we turn this into a royalty? You have to bake in some price assumptions and try to, different views of the future, but there's no reason that can't be done.
Or it's a joint bid between Fresnillo and a royalty company, right? As we said, they don't have the cash to do the whole thing. In cash, their paper a little bit undervalued. Do you say, okay, we'll give you, you fork over $1 billion for a 5% NSR or something like that, and we'll fund the rest. And I don't know if that royalty is worth that $1 billion is a number I've just thrown out. But I think those are all possibilities. So moving on to I guess other things of news flow and things that matter right now besides mergers. Actually, just one more thing on mergers that I want to mention. It. One of our other names is involved in sort of a merger of equals, which is Silver47 and Summa Silver emerging. I think that there's probably, I think that's a creative transaction. You're bulking up the silver assets, makes you more eligible for passive ETFs.
This MAG Silver, it was a market favorite for the longest time. Then the market got tired, abandoned it. Like 2 years before they started production, finally. Then it tripled. And now it's getting taken over. Canadian 25-ish. It was always like a $7 to $12 stock, sort of, as a developer.
Just one other thing on the M&A front, and I think it's a bit of a creative transaction, and I think it's good, is one of our other portfolio names, Silver47, is merging with Summa Silver. I think these types of transactions, these exploration development companies need to be a little bit larger, particularly in the silver space. That exposes them to a little more, pushes them towards passive flows. So the silver ETF. So I think that there's, transactions like this are very good. And so, these are companies that are trying to figure out a way forward, makes it easier for them to raise money. So, something that we watch. We like the transaction. Gives Silver 47 an asset that ultimately the company will be Silver 47. Gives it an asset it can explore, assets it can explore year round. Has some pretty interesting stuff. So we'll see how it progresses from here.
Switching gears, I think we've pretty much done with most of the reporting for Q1, at least from the large caps. And I'd like to pick up where we left off 2 or 3 episodes ago when Agnico reported their initial numbers. And you came back to us sort of with the idea that we're making something like $7 million a day, US. So that was on Q1. I actually run the numbers up to today. The gold price is up about 12% on average, Q2 versus Q1. And, for net income or free cash flow, for a good operator like Agnico, there's about a 2.5 to 3 times multiple on that. So if 12% revenue growth is about 30 to 35% net income growth or free cash flow growth, depending on how it all trickles down. But it's quite substantial.
Yeah, I think that's a great point, Sam. It's like it really almost applies almost entirely to the bottom line, right? So if you think about that 12% is what, $300-400 an ounce, roughly speaking. They produced 870,000 ounces in the quarter. That's so if the rough numbers on that as they go from generating just under $7 million US a day in free cash flow to just over $10 million a day in free cash flow, if it all translates down. Now it's not perfect; you lose some of the royalties, etc. But that's some pretty impressive numbers. So, another company that we think is similar and perhaps is just as good, and probably not enough of based on my evaluation of the numbers here, is Anglo. So Anglo Ashanti is a gold name. It's one we've owned for a long time. We like it for a couple of reasons. One, it's got it's one of the only major large gold companies that has organic growth with its Silicon Ruin assets in Nevada. It's they've restructured and rebuilt that company and really transformed it. I don't think the market's fully recognized it yet. So just for reference, they produced 720,000 ounces in the quarter, all in sustaining cost $1,640. So that all sounds really good on a $2,900 gold price. Roughly is what these two companies, both Agnico had. So what do they generate? $400 million in free cash flow. So that's going to our per day metric. It's $4.5 million a day in free cash flow. Again, take that same caveats apply, but you take that increase in gold price in Q2. That's greater than $8 million a day on Anglo. And so you look at that and go, okay, well, so if they're generating, let's say, they're generating, maybe 50% less than Agnico from a free cash flow basis, roughly speaking, maybe 25 or 30% less. They have half the market cap. Anglo has a market cap of 20 billion. Agnico is 54 billion US. Those are US numbers. So I look at that and go, well, we don't earn enough. Now, a couple things. Agnico's earned its premium multiple. They've been doing it really well for a really long time. And so that $54 billion is that premium multiple is justified. The other thing, and I think that this part is important, is that, there is jurisdictionally, right? Anglo is a lot more diverse jurisdictionally than Agnico Eagle, whereas Agnico has kind of, basically all sort of tier one-ish jurisdictions, or mostly tier one jurisdictions, whereas Anglo is a little more diversified. Definitely has some West Africa, Egypt, for a big chunk of their production, and a few other countries. So I think that's maybe the two differences. I don't think it justifies a 50% discount, especially considering how Agnico has, or how Anglo has progressed. But I think what we just went through though there is what I look at for producers, and what we're looking for is, if we're just trying to evaluate their production and how they're doing, how they're doing quarter over quarter, where that goes. My first read is to free cash flow. One thing I've learned over time is that, you start looking at things like net income or EBITDA or adjusted EBITDA, or if you just look at all-in sustaining costs, a lot of those metrics are, how do you put this? They can be altered or changed, or and are subject to interpretation by the accounting rules. So you have a lot of flexibility in how you report that. CFO plus CFI is free cash flow. It's literally cash outside of the balance sheet, outside of whether you raise capital or you, in this case, dividend distributions and share buybacks. CFO plus CFI gives you that free cash flow number. That's the number that I look for in a lot of companies as a first check. And a company like Anglo, where, while we are interested in the growth of silicon and we want to see that update, Silicon Merlin, our focus is, are they, with this gold price increase, is that translating to the bottom line? Because I guess that's what that's what generalist investors would look at as well.
Yeah, and I think it's a good point to mention how, again, we've talked about this before, how generalists think. And in particular with mining companies, I'm very careful when you look at the CFI, like you mentioned, the cash flow from investing, because in the case of both Agnico and Anglo, they have pretty sizable growth projects that they're funding, which are being labeled as growth, not as replacement production. So in that case, you may be overly punishing them. So I looked at
but that also doesn't show up in ASIC, right?
Yeah.
So that's the problem with all-in sustaining costs, is that they take that capex out, and that number is important, right? And it's important when you're growing, because that's what, like, I understand your point on CFI, but like, one of the things that what early in my career, when I built some of the first sort of cash cost curves, and you can't use what we learned. This is before ASIC was a thing, but like, you can't use anything that the company reports. Like, if they report it as a non-GAAP measure, every company reports total cash costs and ASIC slightly differently. So they're not necessarily always comparable. On a rough basis, they are. As a quick check, okay, Agnico's 1,000, Agnico's 1,183, and Anglo 1640. From an order of magnitude perspective, those are probably pretty close to accurate. But, how are they accounting for growth capex? Some companies, if it's growth capex at an existing operation, they count that as sustaining. If it's growth capex on a greenfield project, they expense that, right? Like, everything has a little bit different. And so, like, but that's why you have to kind of take the whole stack of
100%.
CFO, CFI.
Yeah, no, and I totally agree with what you're saying. When I was looking at these names earlier today, I was thinking, okay, let me take the cash from operations, as in the cash that comes out of the mine site. And Anglo is trading about 12.5 times based on its last, there's a 12.5% yield on that cash flow relative to the enterprise value. We're looking at enterprise value here because obviously this is before interest payments and whatnot. That's attractive, very attractive for any generalist investor. It's an incredible amount of profitability that's coming out of the operations of the company. And if you actually take, like we were talking about, the 12% increase in gold price, so if you were to look at the 6 weeks of Q2, we're halfway through Q2 now, and you extrapolated that to the year, then it's yielding nearly 17% on operating cash flows to the whole enterprise value. For a business of that scale, with the de-risking that they've been undergoing, and with the growth projects that they've announced to the market, this is an incredible company. The amount of cash flow they're generating is going to allow them to build these operations without any substantial increase in equity, in shares. It may even allow them to buy back shares at the same time. So we're standing here in front of a company that's after all these years is kind of finally in its glory days, I'd say. From an operations perspective, I think the share price could still go further to reflect this.
Yeah, well, I think that there's, I guess kind of the point from earlier, that gap, that multiple gap that we see between Anglo and Agnico, right? If Agnico is the gold standard, right, and it's up here, probably a little bit higher, probably doesn't close all that gap, but if it closes half of it, that's a material re-rating. And I think that's, I don't think that that's an unreasonable look. So I really like that from a perspective. Now, looking at Q1 reporting, we look at Anglo and companies that are, kind of just producing. You look at them a certain way, right? I mean, it's got growth capex and things like that, but overall, the share price is going to move more, almost as much on how they translate and whether it becomes more attractive generals, as Sam was talking about. One of our favorite investing themes, though, is funded organic growth that isn't captured by the market and isn't necessarily captured by the future multiple. We've made really good passes in this area, particularly our investment in Karora paid off this way, and our favorite name in this area right now is K92. So when we looked at their quarter, we took a completely different approach to how we look at it, because we're not looking at pure free cash flow. Yeah, we want to see that generating cash and the operations are doing decently. But I think the real key is the update on the growth side.
Yeah, so for those who are not familiar with the company, they're currently operating in phase two, what they call phase two, that's currently operational. They've been investing in phase 3 and 4 concurrently, pretty much all from organic cash flows. There were some offtake agreements in the past, but pretty much all of this expenditure has been funded from the company's organic cash flows. So when you look at the company today, it has about a $2 billion US market cap. It produces about just under 180,000 ounces, and it trades at a decent multiple. So if you're looking at a pure multiple, it doesn't look too attractive. But because they've already funded or committed to 75% of the phase 3 and 4 expansion, and a lot of the money's already been spent, I'm thinking forward and saying, well, if phase 4 brings them to 400,000 ounces, that's roughly what they're guiding. My personal belief is that they will exceed that. Then the production, the numbers we got for this quarter, which are just under 180,000 ounces equivalent, if you multiply roughly by 2 to get to my 400,000, then they're making $70 million a quarter times 4, 280 million. These are all US numbers. If you adjust for the increase in gold price, that's about 360 million. But if you double that, assuming that the production hits 400,000, then it's a company that's, when phase 4 is complete, is going to be at these prices, should be generating something in the region of 750 million in cash flow per year. The market cap today is 2 billion. So 3 times cash flow or 35% cash flow yield. We were just talking about how attractive Anglo looks at 16, 17. We're looking at something that offering you twice that return potential with the associated risk. There's execution risk with the expansion, single asset company. It's in PNG, which is certainly not Nevada or Quebec or Western Australia when you think about mining jurisdictions. But we think the return potential on this name is exceptional.
And just talking about those metrics and what this could become. And I'm going to caveat this: while we like John Lewins a lot, his last name isn't Lundin. If you compare this to Lundin Gold, little bit higher margin asset, but still producing in that 400,000 to 500,000 ounce a year range. Same scale, a little bit better grade or a little bit lower costs because it is better grade. But it's you're looking at and that today, which Lundin Gold's already gone through this growth phase and executed, right? So its market cap is $13 billion Canadian, right? That would be that's 6 times more than 6 times where.
No, I give you the US number, so it's about 5 times.
Yeah. Oh, you get the US numbers? Okay, it's about 5 times then. Yeah. Lundin Gold, that gave the Canadian 13 billion, but so it's 5 times lift on where it is, even if it gets twice that, right? Even if it gets twice that, we're in for a great trade on a name that is incredibly liquid and has a good management team that's executed. So I think that and as a producer and has cash flow and doesn't need to come to market as a developer, and so I think that makes it attractive. Also, 500,000 ounces a year assets at high grade bulk scale underground are pretty rare. Would expect that it starts to become, before it gets there, it starts to become a target of other producers.
Yeah, and I would also add, in case of K92, there is, beyond this phase four growth expansions, there is a lot more to be done on site. Um, there is some significant copper exploration targets. There's other gold areas that are not immediately in the same area, but just adjacent, that they've been drilling. So this could be, the word that we use in space typically is like a district scale type opportunity, multi-generational one. And when we saw it 2.5 years ago, when it went through its rechecking phase, people were expecting they would need external capital. We studied it, and we thought it was the perfect time to get involved.
Yeah, well, I think we met with them at Denver this year, right? And CEO John Lewins was, to describe him, as angry about that people were out there trying to give him, put a financing on him, and so they were spreading to the market that this financing needed to occur, and so it actually unfairly capped the shares in that period. And he was pretty adamant that financing wasn't going to happen. And that's the kind of thing where it makes it really easy for you to go, okay, let's buy. I think we added a lot to our position then, and I think on any weakness, which we're continuing to be average. We like what we see there. They're continuing to execute. So with that, sort of wrapped up Q1 reporting. Talked a little bit about M&A. So that's it for. I think that's good for this week, and we'll chat next week on the news that comes up, or maybe we'll have a company in that we'll take through the ringer.